But I'll tell you in the moment, we're definitely taking a fresh look at where we're investing because of AI. So companies that might have been less attractive a decade ago or 20 years ago, because of the opportunity to deploy AI, may actually be better. Is there a heavy spend on sales and marketing? Is there a heavy back office spend? Is there a heavy spend on software development? Things that are fundamentally changing by the day. We believe that 40 to 45% of all jobs will be changed or different within 5 years from now.
Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Andrew Weinberg of Brightstar Capital Partners. And what I really liked about this episode with Andrew is he talks about how they're leveraging AI to optimize their investments and their portfolio companies to create more enterprise value for those companies. And this is a hot button topic. Almost every private equity event that I attend or get to be a part of, I see multiple panels on AI. We've also done panels ourselves on how marketing and AI can be leveraged together. And a lot of PE investors are kind of thinking about this, but they're not exactly sure where they should focus or what the first few levers should be. And Andrew actually talks a lot about this because they've already been mobilizing this inside their firm. And his partner actually has been the head of AI for Harvard's Research Institute. So there's a ton of background that their firm has in this area. And they're actually also implementing that for their portfolio companies. So there's a lot of interesting takeaways in that. And I hope you learn a bunch of things that you can bring back to your portfolio as well. So with that said, I'll leave you to it. Enjoy the episode. All right, Andrew, welcome to the show. How's it going?
Good, Shiv. Doing well today. How are you doing?
Good. Excited to have you on. So why don't we start with your background and Brightstar Capital, and then let's go from there.
Great. So I started Brightstar Capital just over a decade ago. So we're celebrating our 10th anniversary. I've been in the industry for nearly 30 years. Pretty traditional background. Worked in investment banking at Morgan Stanley, private equity at Goldman Sachs. Spent time at Stanford Business School, so I think some of the audience will resonate with some of that background, although I think I realized during my time there I wasn't ready to be an entrepreneur. And so I went back east, although my roommate did drop out and start StubHub in our off-campus apartment, so I got a taste of the entrepreneur life. I worked at another private equity firm and really kind of honed my skills and knowledge of the sector. And in 2008, I had a fork in the road because I had an investment that was heading into the GFC. And the founder of that company asked me not only to stay as the lead partner or director on that company, but to also become the COO of that business. Mm-hmm. And I started commuting from New York every Monday morning at LaGuardia at 6 a.m. It was the sort of usual suspects. I knew exactly what seat everyone would be in that morning, because it was the same thing every week. I'd come back Friday night. Sometimes I'd travel the weekend. But during that experience in reshaping that business in the crisis and actually taking an operating role, it opened my eyes that private equity should be more than just investing. It should be investing and operating, what we call the us and us model. Fast forward, we end up monetizing that investment to SoftBank. My partner in that company is now my partner today, although we took a few years off. He took time, Marcelo Clary, to be CEO of Sprint, global CEO of SoftBank, chair of Harvard's AI Institute, board member of T-Mobile, and now he's my partner and co-chair of Brightstar Capital Partners. So I'm here today because of that experience with Marcelo. I'm just a late bloomer as an entrepreneur.
That's a fantastic background. So talk about the specific idea that you mentioned about investing and operating as a vision for private equity. How's that different, or how does that run counter to how a lot of other firms are perceiving the companies that they're investing in?
So, I think our industry has gone through waves of evolution. Whether you call us on 3.0, 4.0, or 5.0, I'm not sure. But if I look at the early days of private equity, a lot of it was marked by high levels of leverage. It then morphed into financial engineering. maybe then it morphed into sort of buy and build. I think the last wave has sort of been the operational know-how. And when I started this a decade ago, I thought, gee, there's $105 trillion wealth transfer. At that time, it was less than half of that, of one generation to another of these great businesses in the US that, according to our research, 60% of them don't have a succession plan, whether that's because the parents don't want the children to work for them or the children don't want to work for the parents. So there are these great businesses out there that are private businesses, and they generally need or want more than capital. So a large group of them, we think, benefits from the know-how of making enough mistakes in other places that we can bring that know-how to the table, and hopefully a few things that we've learned to do well. We don't want to be C-levels or operators again, but we're bringing that know-how to these companies to help them fundamentally change their rate of growth in a positive way. When we married those two up and said to someone, there's a lot of private equity capital out there, but if you think that 2 bites of the apple, not one, is worth something, we'll happily put our time and our resources in to help you with your business. And that's been our journey so far. We're about 70 investments into that journey. And I'm going to leave you with something here that hopefully we'll keep talking about a bit, which is the next leg of our evolution has tracked where the world is going, which is we think we've developed a pretty strong team to deploy AI use cases in our companies. So taking traditional private equity investments, getting the returns that we'd expect, and supplementing them with the use of AI. And we're doing it today. And we've made a number of hires there today. And having Marcelo, again, lead director at T-Mobile on AI, chair of Harvard's AI Institute, one of the thought leaders in the world on AI, in my opinion, helping lead that effort for us has been transformational.
Yeah, so many threads to kind of open up there. I want to start with just the focus or the types of companies that you're investing in, and then let's expand into how you're adding value there. Yeah. So you mentioned this idea of the wealth transfer that's about to happen. A lot of these companies are family-owned businesses that are kind of passed down generationally or are about to be, but they're run very differently than, let's say, a professionalized institution or organization would be. So how do you vet those types of companies? And then talk about the sector focus as well, because you're in more of these traditional industries that maybe not as many PE folks are looking at.
So I would say I'm not sure if they're run differently than the great businesses. In other words, the great public companies and great private companies and those that are closely held, I think each of them share a common DNA, which is a great culture, a meritocracy, an opportunity to really move up. I think in closely held or family-owned businesses, there are occasionally challenges with how do we deal with ownership over time? How do we deal with incentives and alignment there? But I do think a lot of these businesses that have proven to thrive through cycles or make their way through cycles, have something in them that maybe other companies don't. There may not be as quick a transition of leadership. And so the leadership has lived through cycles. And that pattern recognition is worth a lot. We try to find the companies that are good companies, that are strong companies, that might benefit from having a partner, maybe introducing things like M&A as a supplement to the traditional value creation to grow the business, where maybe the family or the ownership didn't want to risk all their capital or a meaningful part of it in that growth. We've really focused on a few sectors to date. It's really been in industrials, business services, government services, and technology. We've generally focused on businesses that are outgrowing GDP, have inherent operating leverage. But I'll tell you in the moment, we're definitely taking a fresh look at where we're investing because of AI. So companies that might have been less attractive a decade ago or 20 years ago, because of the opportunity to deploy AI, may actually be better. Is there a heavy spend on sales and marketing? Is there a heavy back office spend? Is there a heavy spend on software development? Things that are fundamentally changing by the day. We believe that 40 to 45% of all jobs will be changed or different within 5 years from now. So
So talk
Go
about
ahead,
that
Shiv.
piece a little bit more because you've opened the AI thread a couple of times. So just as you're looking at these companies, how are you underwriting that? Because a lot of these traditional businesses, there's a lot of offline or like supply chain work that goes along with owning that type of a business, different types of complexity. So how do you underwrite as you're looking at the company the work or benefit that AI can bring to a particular
Yeah.
investment?
So look, we're largely benefiting from the 300 to 350 billion dollars a year being spent on the AI factory by others, the data centers, the semiconductors, the large language models, the power generation. And we're taking that learning and those use cases and the ecosystem that our team has built around AI. And so we've been talking to our portfolio companies and our investors for the better part of a year and a half about deploying AI. And I think the key for us is truly it's a line item by line item focus on the workflow. And where do we want to prioritize our time and effort with our ecosystem? And obviously, the outsourced partners out there who are developing, who are in that AI factory, the market leaders, and where can we actually do something that generates a better business? Could be a better experience for our customers. It could be a better pricing model. It could be better operating leverage on the business. But it's really a ground up business. So again, we're going back to our traditional value creation tools, which have played out. We exited 3 of our businesses through full sale processes in 2024, all of which had stories of fundamental value creation. One of them had done no M&A and had grown quite a bit. Now with this additional lens, we think this is supplementary. The only thing I'll say though is we have to look at where we think that business will be in a few years and where's that industry going to be and how will that be evaluated? Because we don't want to invest in a business where someone will look back and say, oh, that business is less relevant today. So we've changed our own business practices at Brightstar in terms of how we underwrite our underwriting process, our use of all the AI tools, deep research, et cetera. And it's really become part of our DNA on an hour by hour basis.
If you think about the value creation, you mentioned traditional value creation levers. If you think about it as almost like a pie chart where you look at more of the traditional levers versus things that are more revenue growth driven or AI driven, what percentage of your value creation thesis is around the AI side?
Yeah. So traditionally it was 0 before a year ago because it really didn't exist in our ecosystem. When I say we kind of got there the hard way. Now that we've done it, I'd probably put a split of something like 75% or so is traditional and about 25% AI. And I think if we have the same conversation in 6 months, it's probably going to look more like 50-50. So the large companies in the AI sector are clearly developing use cases that we think, again, are not a commodity because it boils down to the ability to actually use them at the company level and fundamentally change how many of us spend our day and how we allocate our time. Sales and marketing efforts, especially B2B, are changing overnight. It's arguable, though, we might be on this discussion in 5 or 10 years, and it could be 90% AI.
Yeah. So can you bring that to life a little bit? Because I get the sales and marketing side. I understand certain things can be automated, but like, how do you see it accelerating that quickly? Because it's obviously AI is a hot button topic. A lot of people are talking about it. Every session on private equity seems to have some type of an AI element to it. But bring it to life for us with the types of investments you're making beyond just like the standard areas like sales and marketing where people are using workflows to maybe make things faster or automate outbound or something like that. Like, how are you seeing that play out in the types of businesses that you're investing in where there's supply chain involved and other complexities?
Sure. So I'll borrow first from Marcelo's experience. Again, he's the former CEO of Sprint and the largest individual shareholder at T-Mobile. That'll boil down to a couple of our portfolio companies. In that particular case, what's been publicly disclosed is, a goal to reduce inbound call volume by 90%. So it doesn't start with a 90% reduction in staffing. It starts with putting in digital twins, putting in models that are able to understand the customer incredibly well and address the customer needs, And therefore, the need to actually use that call center drops by 90%. Well, a derivative of that also is the store count, right? So the interface is not only a call center in that business model, it's a storefront. And that storefront is not only there to sell a new device, but it's there to help triage issues with your current device or your current plan. Well, if you don't, again, have a service issue because it's been addressed already, the store count meaningfully comes down. It's a significant reduction in real estate cost. It's a reduction in commissions. So that's a very publicly disclosed use case that's happening in real time at a quite large scale. I'm going to boil it back to what we do. So we have the second largest business to business auto auction business in the country. It's called America's Group or America's Auto Auction. It's number 2 to Manheim. Manheim's owned by the Cox family. They've been a great steward of Manheim for a long time. We've generally been the growing business of choice, aggregating a lot of mom and pop or family owned businesses into our company, adding geographies for effectively what is a business that auctions a vehicle every 10 to 15 seconds, once a week in a geography, physically, but with a huge digital element to it. In that particular business, the ability to use technology and AI for a quality control process as that vehicle is coming in or being inspected, the AI can actually identify both the perfection or imperfection of a vehicle on a better basis than a human can. That business can understand, taking logistics cost of moving a vehicle, the demand because of use of digital twins for our customers, which number a couple 100,000 customers, and then being able to tell that customer, if you like this vehicle today here, 60 miles away tomorrow, we're actually auctioning a similar vehicle and here's the price. Well, that allows us to address growing demand for that, generating demand, but also understand our pricing model to make sure that we're hitting the right price point for our customer. We're just a marketplace. We don't own anything. And I could give you another 20 use cases just of that one portfolio company alone. We have a roofing business that largely works with the warranty on roofs of customer homes in the Southeast. The ability in that business to remove the person from climbing up a ladder, standing on a roof to assess it through flying drones, AI, again, quality control, looking for imperfections, and being able to address it. It helps both on the front end on the sales cycle, and it helps in the triage and the project management, which is effectively what we are, to manage that process to get that roof repaired. So each one of these has a huge AI opportunity. And for us, I'd say the hardest part is being able to package that in a way that is easier to implement and does not disrupt the business.
Yeah, especially since you're buying these family-owned companies or getting involved with the almost generational operational structure, I guess. How do you manage that? And I would imagine inside these companies, there's often a bloating of expenses or a lot of personal and professional things kind of are interlaced in between. So and then meanwhile, you're coming in with like AI recommendations or opportunities to streamline the business and make it more efficient. So how do you navigate that? And I guess there would be a big opportunity there, especially because there is more inefficiency.
Yeah. So I don't know if I agree that there's a bloating of expenses, just because I want to say there's a reason these businesses are still thriving, which is with an owner mentality, I actually think they're generally more cost disciplined than maybe some of their public peers. I promise you, when you own the business, and I think you probably, own your business here versus I work for someone or there's someone else that I work for. The owner's mentality is actually quite important. But what we do is we've developed a set of materials and playbooks, and we have kind of a walkthrough process. And what we like to do is share our findings before we invest. So there's no mystery or no surprise. I think part of the attraction to work with Brightstar and our 65-person team is the ability to lean on those playbooks, lean on that know-how, and be able to talk to the ecosystem of our partners. We have 30,000 employees across our base. We're generally control investors. But we don't try to do everything at once. But as we do with our traditional value creation, we prioritize the lowest hanging fruit where we can make the biggest difference. With AI, it really relies upon a strong financial foundation, a strong base of data. So the early days are generally more about data cleanup, putting the right systems in place. Once that's in place, the empowerment that the management team and ownership can get from having this, generally in industries where their peers are not using it, creates what we think a great advantage that we look to use in our business.
Yeah, that makes a ton of sense. What are some of the other areas, especially with the types of companies you're investing in beyond the AI side, that you're investing into to drive more value creation inside these companies?
I'll give you a few generalities here and across it. I would say many of the companies we work with, again, have a great culture, and many have an ethos. And I'm talking about, look, we see hundreds of companies every year. I'd say there's probably an ethos of a little bit of wanting to please the customer. And of course, we don't want unhappy customers. But I'd also say that generally, 80% of the noise from the customer base, and mostly business to business environments, probably comes from 1% to 2% of the revenue of the customer base. And oftentimes it's important to empower our management teams that it's okay to educate the customer on what our value proposition is. If we think that good or service has been underpriced, or we're bringing something extra to the table that's not being valued, we want to make sure to communicate that. And if you can't make a customer happy, no matter what you do, sometimes it's time to have a discussion. Should we really be partners? Should we be working together? And giving the management team that freedom to move on from a customer where it doesn't make sense generally tends to be liberating for that management team. Again, they might be doing it already, but I'd say that's a commonality on the sort of pricing side of our business. Investment in the business and investment in the company and growth. Again, most closely held businesses are going to be a little conservative relative to us on capital structure. We're not generally aggressive, but they'll be a little more conservative. We'll look for opportunities where we can make an investment. I can think about an investment we had in a nutritional products manufacturing business in Utah, where, the day we closed that deal, we held a board meeting within 1 hour and approved $10 million of CapEx in a business doing about a similar amount of profit. But the payback was like a year and a half. And the opportunity to communicate to the customer that we're willing to invest in the business. Do you want to invest with us? Will you give us some more business if we prove that we're doing that? We've generally invested a lot in training. So we had a fleet maintenance business that we publicly sold a majority to New Mountain last year for. We shifted that business from having no electric vehicle OEM contracts to more than 10, and having to retrain some of our workforce from being a traditional mechanic to effectively being a hybrid with a software engineer. I mean, I saw some of the results. I can't say if they were a customer, but I was in a Waymo in San Francisco and Los Angeles, and the person that's doing the work on that vehicle is a different person than doing a traditional combustion engine. So again, I could go on, but the use cases are significant.
Yeah, that's fantastic. What about on the people side? How are you adjusting these organizations, especially with the AI side and some of these other value creation levers as you're coming in? Are you trying to keep the org as is? Or are you trying to find efficiencies so that one person can do the job of three? Like, what's your perspective on that?
We've generally been net growers. And so the hallmark of our strategy has actually been a growth strategy, which is, call it just under 20 platform investments, 50 add-on acquisitions. So we're generally actually adding quite a bit in terms of headcount over time. And hopefully that's doing something good for the economy. At the same time, we're investing in significantly, I'd say, high grading over time, which is investing back in our team and our people and training and resources. And a company at a certain scale, if they double, triple, quadruple, can all of a sudden afford to bring in some talent that may not have wanted to join that company on day one. And with that talent comes know-how. So if we're lucky enough to have management teams that are lifelong learners that want to adapt to the environment, which I think we do, we're bringing them tools that they might not have had already. And at the same time, we're bringing those tools and pushing it and driving it through the workforce. Now, it might mean that someone's job, and I think this is going to happen with or without us, there's a job today that will change 4 to 5 years from now. Do we think we have the right athlete, the right person that can move and adapt with us? Well, clearly we did it at Merit because we took the person that was a traditional mechanic and they became a software engineer with part of their time, for the same reason that, we occasionally complain that, why doesn't my car work? And it's a chip issue. It's not an oil issue. But I think, in terms of opportunity, I think for those that choose to work with Brightstar or firms like ours, I think it's going to be a pretty exciting run that will be a little bit different than maybe some of the public companies out there where you see these waves of hiring and firing. I think we tend to be a lot more stable environment.
Yeah, I'm a big believer in that, where you want to have a steady increase over time because institutional memory is so important. And when you hire and fire, it becomes a lot harder. So talk about that piece, especially as you're buying these family-owned companies. Like, how are you working on retaining that institutional memory and preserving a lot of the culture that's been built by a founder that's built a company over many years?
So I think for a lot of the founders, it's actually great bringing in more of an institutional partner like a Brightstar, because we have the experience of really creating, I think, alignment tools that are long-term in nature. They tend to go beyond, let's say, cash bonus plans, 1, 2, 3 year retention plans or bonus plans. We really try to align. If we do well, right, we want our investors to do well, the endowments, the foundations, the insurance companies, the individual investors, et cetera. We've generally grown that ownership base quite a bit. And the knock-on effect of that is it has a direct positive impact on the communities they're in. Last year, we exited our Bobcat dealerships. We own roughly 1 out of every 8 Bobcat dealers. For those not familiar, it's skid steer loaders, mini excavators. The parent company started as a Clark Equipment company in Minnesota, then migrated to the Dakotas. But a national business, and our footprint spanned from the Carolinas to the Midwest to California. Well, we had really 3 principal owners of businesses that we combined. And we had more than 50 owners when we monetized that. So 50 people, 50 families got distributions that were meaningful from that event, had an opportunity to roll over with the family that acquired the business, and are out there continuing to grow that business today. So we think we had a fundamental impact and positive change on 3 great businesses that were integrated by growing that. And if that culture continues, we think that ownership mentality, that entrepreneurship mentality, is something that's quite positive for our ecosystem.
Yeah, I think some of that is just so important because you buy these companies and the founder has kind of laid the foundation. And I think more PE firms should consider retaining some of that institutional memory, because sometimes you kind of come in and fully do a full reset of the management team in the first 90 days or whatever. And the new group doesn't have that knowledge to actually be able to take the company into the next level or the next phase of that business. And you kind of have to recover whatever you've lost in terms of human capital.
I think the great balance is, can you retain all that knowledge and yet bring something fresh to the table that the current owners were asking us for, right? So generally the need is for more than capital. It's, I want to do this, or I'm thinking about doing this, or I think the next generation is ready for this. Can you help me train them? So again, I think going back to AI for a second, no one has the playbook on AI right now. It's continuing to evolve by the day. I'm happy to bet that I think we're going to be a decent solution to solve that gap in this $105 trillion wealth transfer. And I'll tell you, in meetings, we probably get more follow-up to say, I'd love a chance to work with you. I want to spend more time on AI. Like, tell me what I don't know. And that also applies to our investor base. We get a lot of questions about how are we using AI in our own investment process.
Yeah. Do you think some of it is it's almost like people are over-indexing on the AI side and maybe passing by some of the core value creation levers. Like, how do you balance that? Because the fundamentals are still very important.
My assumption will be, and I can't prove this in the moment, is to the extent that you weren't a traditional value creator, in other words, you approach this from more of a venture or growth background, and it's just all about AI, there wasn't the muscle memory of how to actually do the fundamental value creation. For us, it's truly that fundamental value creation and now supplementing it with AI. And then we basically rank and say, where do we think we're going to get the most value creation from? And we're pretty dispassionate. It could actually be that AI is like number 6 out of 10, or number 6 through 10, and number 1 through 5 is traditional, or it could be vice versa. But we're dispassionate about it. And I think depending on one's orientation and what the proposition has been, it could overweight. I do think there's a huge amount of capital being deployed. We don't play in the venture world. My assumption is that anything with AI in the venture world gets funding these days. Again, I go back to my Stanford roots. There's a lot going on in Silicon Valley. And I think if it says AI, you have a better shot at getting funded. For our base of partners and what we do, I think we're more dispassionate.
Yeah, I definitely think that that's the right approach, because I almost see it as like a order of operations, right? There's the fundamental things that a lot of these businesses don't have in place. And as you start to look into those fundamental areas, then AI becomes a way to either supplement or amplify or find efficiencies within those levers. And that might be the first place that you go before you go the route of like fully AI as a value creation lever in and of itself.
Yes, I liked your order of operations, or PEMDAS reference there. There's probably going to be an AI version of continuing order of operations. Look, I think take it to the extreme headlines are the ones that grab people in terms of reductions of people, or AI taking over. What I like about our industry in particular is a person today decides in a private business to buy or sell. In between the value creation, I'm not sure what's going to be overweight, but I think it's tilting towards AI. And at the end of that journey, a person decides to buy or sell, very different than the public markets, which can be fully automated. So again, we have to basically, we put our money where our mouth is, but we also have to be able to articulate a plan. But I'm a huge user of AI constantly. I'm not using it on our conversation right now, but if I'm in a diligence meeting, I want to know as much as I can. I want to be as responsive as I can. And the ability to pull information together on a short basis is unbelievable.
That's super important. Yeah, that's a great note to kind of close this off, because we're coming up on time. But before we do, Andrew, if there is a family business listening or other investors that want to get in touch, what's the best way that they can get a hold of you?
Yes, if you go to our website, www.brightstarcp.com, there's a link right there. We'd love to hear from you. You can click through with an email, and we'd love to talk to you. And I'd say we're really in the business of building relationships. It's not about investing in a deal or a company. Out of building that relationship, it might come, but we might just be a great sounding board for you. And I'd say part of what we do is continually free advice. With all the caveats from a legal perspective, we're happy to give advice because oftentimes we're not the right solution, but we probably know someone that is, and we want to be a great partner. I think if you pay it forward in life, it ends up being a pretty fun journey, and we love to pay it forward.
That's awesome. And Andrew, with that said, thanks for coming on and sharing your wisdom. We'll definitely be sure to include all of that in the show notes. And I think even just for a lot of PE investors that are listening, as they think about how to layer in AI into their value creation efforts, I think there was a lot of great insight. So appreciate you doing this.
Thanks for the opportunity, Shiv. I really appreciate it. Have a great day.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.howtosas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.